Hey, welcome into another episode of The Fearless Investor, but it's our side segment with Chris Miles, the Chris Miles Money Minute. And I just want to remind everyone, if you have not already, make sure to go to fearlesskyle.com/Chris Miles. You can get a free financial evaluation from Chris. He's already talked to a lot of our listeners, and he's helping out a ton of listeners here on the Fearless Investor podcast, helping them to get to retirement faster, okay? Ditching the financial advisor route and trying to think not about how can I retire in the future, but how can I retire faster? How can I get to my passion projects faster? That's what Chris is all about, and that's why we love having him on the show. Every single last Wednesday of the month, you can rely on Chris Miles being on here for the Chris Miles Money Minute. So Chris, thanks for being on, man.
Hey, it's such a pleasure, Kyle.
Awesome. So we are going to talk about something that really kind of, for me, when we first talked, it was like almost feels like half a year ago now. We had a really controversial topic of Dave Ramsey.
Yeah.
And it got a ton of views. A ton of people were either for it or against it. And so we're going to kind of take that same idea right now and talk about debt. Should we pay off debt, especially right now with what's going on in the world? Does it now maybe makes more sense to do the Dave Ramsey thing since things are a little bit more unsure out there? So I'm going to give you the floor. What is your take on debt right now in this society?
You know, paying off debt might make sense, or certain types of debt or certain loans in your situation. It's not always the same type, though. There's always a different scenario that's going on, right? And I learned this from the last recession. Again, like we talk about Dave Ramsey, he's not a horrible guy, right? But he tries to blanket statement everything, and you cannot blanket statement a strategy. Principles are great. The principle is live within your means, produce more than you consume, right? That kind of stuff. But we want to get into like, really, does it make sense to pay off debt? Because what's the best use of our money? Do we invest it instead? And so many people have been asking me lately, they're like, yeah, I think I'm just going to pay off all my debt, which is an option. But is it the best option, right? And so for me, it always comes back to this one thing, and that's cash flow. What's going to ultimately help you have more cash in your pocket month to month, right? It doesn't matter like how much you pay down a balance of a loan if your monthly outgoing is the same, right? This is why I'm not a big fan of paying extra payments towards your mortgage, student loans, car loans, anything that has a fixed payment that until it's fully paid off, you can't do anything about it. So tip number one, if it's a loan that the payment doesn't go down, like a credit card, when you pay it down, the payment goes down too. That's good. That helps. But if it's another type of loan, like a car loan, mortgage, student loan, those kind of loans, installment loans, right? It's good not to pay extra to those loans. Do not pay the extra to them. That's the worst thing you could do, because right now, if something bad goes on, you get furloughed or laid off from your job, you can't just ask the bank, hey, I overpaid you $2,000. Can you send me that money back? Right? So
absolutely. Well, and you and I are on the same mindset here. I mean, I literally just ended up not doing a refi because they wanted me to pay off my car loan. And I'm like, that's dumb. Like, that's going to be $9,000 that could create way more income for me rather than just, and the only reason I was doing a refi was because it just made sense right now because I was going to get a lower rate. But I'm like, man, if it's going to cost me $9,000 just to get a lower rate, that doesn't make any sense. That's not going to, it's going to adjust my cash flow a little bit, but $9,000 to maybe call it an extra $100 of cash flow per month. I could see that money, especially in the Airbnb world, with me using that $9,000 to go furnish and arbitrage an Airbnb and make $1,000 a month. So it just didn't make sense. So I love that mindset. Now, someone here might be saying, well, Chris, but if I do pay off a loan, that does increase my cash flow. So why are you saying not to do that with the car payment or with the student loans? What would you say to someone like that?
I would say if you're going to pay it off in one check. Just pay it all off. Just like the bank was telling you to pay off the entire thing, right? By the way, interesting thing is about banks. They're saying like, hey, I want you to pre-qualify for this mortgage, right? Whether it's, I had a client 10 years ago where they're trying to pre-qualify, but their big hang-up was debt to income ratio, right? Their minimum monthly payments were too high compared to the income they were stating on their tax returns because they were business owners, right? So they made good money, but they were showing they're like paupers on their tax returns. So I said, all right, well, let's look at this. And they said, well, I got rejected. I can't refinance my mortgage. And I said, well, did they tell you how much per month you need to free up? because all they told them was pay off this credit card that had $7,500 on it, right? Which would free up $76 a month. I'm like, well, what do you need to free up? So they said, well, let me ask. And they asked and they said, you need to free up $44 a month. Well, I said, well, that's not the whole credit card. You
Right.
can, if it's, and it was of course a low payment, 76 is nothing, right? For a credit card, that means for every $100 you charge, you only have to pay $1 a month, right? I said, instead, pay down only $4,400 of this credit card, leave the other, $3,100 on it, and watch what'll happen. And so they did refresh the credit. They qualified for the loan, saved them $3,100 by not paying it all off, right?
Right. That's awesome.
And that goes to a key equation. Like the equation I used that I learned at that same time during the last recession, because I was looking at limited funds. Like, do I invest it or do I pay off a debt? And it came down to this, is I use an equation called the cash flow index. Now, this is something that when I was going through my hardest times, it was an equation I created for myself to figure out which debt to pay off that gives me my biggest bang for my buck.
Okay.
Or in other words, how can I pay the least amount of money to free up the most cash flow? Or if you're put in investor terms, what gives me the better ROI on my cash flow, or cash on cash return, right? So I take the balance of the loan, I divide it by the minimum monthly payment, and that will give me a number. So for example, let me give you an example of two different loans that maybe you have to choose between. Say you have $10,000 in cash and you've got two different $10,000 loans. One of them's a car loan for $10,000. You're paying $500 a month.
Okay.
The other one's a credit card for $10,000 and it's at 20% interest, and you're paying $250 a month.
Okay.
So if you were Dave Ramsey, naturally, if all you had was 10 grand, he's going to say, pay off which one? Credit card or a car loan?
I don't know what he would say. I think he would say credit card.
Oh, absolutely.
Yeah.
Hands down.
Okay.
Like credit cards, get rid of them. They're horrible. And then attack that car loan, right? Because the high interest, he focuses a lot on the interest and that sort of thing. Here's my key tip for you. Ignore the interest rate. In a tiebreaker situation, it's great. But that should not be the primary reason, because banks can manipulate you based on the interest rate. They know exactly how to play you like a little puppet based on what the interest rate is, right? So what you want to do instead is say, well, let's do this cash flow index. So if you take the car, 10,000 divided by 500, right, is 20.
Right.
The credit card, 10,000 divided by 250 is 40.
Mm-hmm.
Now, just think, even if you're not even looking at that number, think from a pure common sense standpoint. If you're trying to lower your expenses by as much as possible, which one's better to pay off?
If you're going to lower your expenses, it makes sense to pay off the one that you're paying the most for every month, right?
That's right. The car loan
payment. Yeah.
Yeah. The one that's $500 a month, right?
Right.
That's an index of 20. The lower the index, that gets the highest priority. The lowest index number gets the highest priority, right? Because think about it. If you pay off that $500 a month, now all you have is a $250 credit card. You can always take that $500, slap it on top of the $250, and pay off that card within a year or something, right?
Right.
But here's the thing: is that people think, well, yeah, but the interest is killing me. And they keep focusing on the interest rate, which is exactly what banks want you to do, right? Mm-hmm. Again, they play you like a little puppet. So the thing is think of real life. If you're in a situation where either your income dropped the next month after you paid off, let's say you paid off the credit card, right? Your income drops the next month, or maybe the expenses go up, and so you don't have as much cash. Which one do you want to be paying every month? $500 a month or $250 a month? If I had to choose, I only want to pay $250, not $500. Right?
Absolutely.
And that's what I realized, because my thing is I could have been debt free even in the recession, but I was still negative cash flow regardless. But if anything I could do to free up cash, that was key. And so the lowest index number is the one I pay off first. Then after I do that, then I can move up. Now, of course, if it's like I said, if it's not a credit card, if it's like car loan or something like that, here's the other key. If it is a low interest loan, like cars, mortgages, student loans, which usually are, I usually wait till they're at least below a 20 index before I pay them off, even if they are the lowest one right now. The reason is what you mentioned, right? It's like, listen, if I got a 3 or 4% car loan, I can easily beat that investing it, right?
Absolutely.
And this is where the key, you mentioned this earlier, the key is really about you as a steward. How do you know what to do with that money? If you don't know how to do anything with your money, you don't know how to invest, that's an easy one. That's your investment, right?
Right. Saving money is your investment.
It might be good to learn how to invest.
Absolutely.
So that's the key. You do that, you focus on those things. I did that with a guy where he had seriously like $100,000 of different, well, he had a few $100,000 of debts, including his mortgage and stuff. And I said, listen, if you pay off some of these loans and we can get it to the point where you can refinance your mortgage, we'll free up $50,000 a year with just 100 grand. That's a 50% rate of return. But he was like, no, I can't do it. I can't tap in the IRA. I'm like, get the money out of the IRA. Like, that's where you've got it. And finally, it was his wife that convinced him, right?
Nice.
He did it, freed up the $4,200 a month. It was like the best returning investment for him in that moment. And he even started making more money in his business because he relaxed. He had more passion. He had more time. He felt like he could relax and not have to force to be made money. And that's the key, is like, debt's not always bad, but knowing which one to pay off and which one not to. Some of those debts I never pay off. Student loan, it took me 15 years to pay off student loan. It got down to $3,000 balance before I finally said, all right, I'll pay it off, because I
That's
knew I could
awesome.
make more money, right?
That's awesome. So first of all, I just want to recap for everyone. What Chris is talking about is taking the entire loan. So this is the cash flow index, taking the entire loan, dividing it by the minimum monthly payment, not the actual monthly payment, the minimum monthly payment. And if it's under 20, then you start attacking that one first. But if you have to pay off any of them and you're comparing them, just take the lowest number one. Is that a good evaluation there?
Yeah, exactly.
Cool.
Yeah. If it's those low interest loans, wait till it's under 20. Otherwise, just go for the lowest one. Credit cards, if it's under a 40, especially, I usually try to prioritize those.
Okay.
Once you get up above like a 50 or so, that's when I'm like, can I refinance this? If it's a mortgage, by the way, key number for mortgage, you want that number to be at least a 200.
Okay.
So if it's a $200,000 mortgage, you don't want to be paying more than $1,000 a month, with
Right.
principal and interest payments. So that's the
So
key there.
So you're saying at least 200 is in 200 or lower, or 200 and higher?
200 index. Yeah.
Right.
So
You said at least 200 though. So I like,
at least. So
yeah.
200 and above. Yep.
Okay. 200
The
and
higher
above.
the
Okay.
number, the better. If you're not going to pay it off, right? You want to get that up there. So I've refinanced car loans before where they maybe got down to like a 30, but I'm like, well, I can get a good interest rate or even a better interest rate than I have now. Let's refi it, make it stretch out the term a little bit more. And then bam, now I'm back up to like a 50 or a 60, so
Yep.
frees
Absolutely.
up cash.
So you might have already answered my question here, but I wanted to give you a real life scenario before we wrap up this one. I'm
Yeah.
going to give you one of my rental properties. It's got $180,000 left on the loan. Every
Mm-hmm.
month I'm paying $1,300 with all of my expenses on the mortgage. And so, but I cash flow, because it's an Airbnb, cash flow upwards of $1,400 a month.
Uh-huh.
So one of the things that I love right now as I'm continuing to build my business is that I've already reached what cash flow I need passively to be able to live within the means of which I want.
Yeah.
Now it's like, okay, do I just keep pocketing the cash flow, or should I take maybe like, call it $300 of that and put it towards the principal to pay off that loan faster? So in other words, instead of having $1,400 of cash flow,
Mm.
let's call it $1,000 or $1,100 of cash flow and putting the rest towards that principal. What do you think?
Not at all. I mean, the hard thing is because when you put it into a property, right?
Mm-hmm.
Now it's in the bank's control. Now the
Yep.
bank lessens the risk. And that's exactly what they want you to do. They want you to pay off that loan as fast as possible,
Yep.
right? Where that increases your risk, but decreases theirs. So I would recommend instead, like, taking that equity, right? The extra payment and saving it on the side, and that's
Yep.
where, like, we've talked about life insurance before. That's a great place to store it where at least you can grow tax-free and exceed even the interest rate that you're paying on that mortgage. You could do that kind of thing and just stuff it over there. And then as it builds up, you could pay it off, right? But again, pay it off with one check. That's the
That's
key.
good. Well, if the value of the property goes down, you've been paying off all this principal. Now that's literally money that you
That's
just give to
gone.
the bank for free. Yeah.
Yeah, that's what happened to me. That happened in the last recession. I started sinking equity into those properties. And then all of a sudden I said, wait, now they're depreciating. I can't get access to them. Even if I sell it, now I'm short selling and
Yep.
I've lost all that cash. I would have been better off keeping that cash in my pocket in case crap hit the fan, which it
Yep.
did.
I love it. I love it, Chris. Hey, thanks so much for being on another episode of the Chris Miles Money Minute. Again, guys, if you want to get a free evaluation from Chris, all you got to do is go to fearlesskyle.com/Chris Miles. Chris is spelled with a CH, and you can just fill out that 5-minute application. He's just going to ask you a couple questions, and you can get right on the phone with Chris to see how he can help you get to retirement quicker. Chris, thanks for being on the show.
Such a pleasure.